Hi, I'm Peter Switzer. Welcome to the program which puts you in touch with the best and brightest minds in the business. On tonight's show, with the stock market up 9 days in a row, is this a great omen for 2015? We'll put one of the country's best fund managers, who was negative in 2014, in Geoff Wilson, to see whether he's the bear inside Geoff Wilson has turned into a bull. With the RBA shocking some hotshot economists with their rate cut today, let's see what ING Direct's Treasury boss Michael Witts thought of the decision and the RBA's negative statement that went with it. Morgan Simon Bond will put a number of companies under the spotlight to see if they are flyers or sinkers, and to get the view on our market spike, the currencies dive, and the RBA's rate play from someone who lives on the market edge 24/7. I talked to Evan Lucas of IG Markets. Stay with us for the next hour. We'll bring you all the latest corporate news and market analysis, plus learn some valuable lessons from Australian success stories. If you have any questions for me or our guests, email them to Switzer at switzer.com.au, and you can follow me on Twitter, and the handle is @Peter Switzer. Now, after 9 days in a row, as I said, of a rising stock market, does renowned fund manager Geoff Wilson think this is the start of something good? Geoff joins me in the studio to look down the time tunnel for stocks in 2015. How are you, mate?
Good, Pete. Looking down the time tunnel.
Yeah.
Look at it, it's not a crystal ball anymore.
No, I thought the time tunnel this year. and also, I really did build you up. One of the best fund managers, the renowned fund manager.
You know what,
you're going to have to deliver.
Over-exaggerate, yeah.
Over-exaggerate. That's nearly tautology.
Exactly.
You know? All right, now, before we start talking about stocks and what you think is going to happen, the RBA decision today, what do you think?
To me, it's a great decision. And everything we had seen led us to believe that they should cut rates. And I suppose we've been saying since the latter part of last year, early part of this year, that they should cut rates. We think there's at least 0.5% in terms of rate cuts. And why we're saying that was because all the companies we were talking to were telling us how tough the real economy is. Now, there's some segments, anything plugged into housing that's doing well. But the
finance sector doing okay?
Exactly, finance doing okay because of how the equity market's been performing. But really, anyone else plugged into retail spending or into the consumer were finding it very difficult. And so, I didn't think they would necessarily cut rates. I'm incredibly happy that they have cut rates because now we've got a chance.
Do you? Let's go back to where you were. You were bearish last year. Was it primarily because of what was going on domestically, or did the international environment worry you as well?
A combination of the two. I mean, the funny thing is, one of the reasons we're bearish is one of the reasons why the Reserve Bank cut rates. Because the economy is not performing.
It's slow.
And they've realised that, and they obviously have more data than us. The GDP figure is going to come out soon, and I would say that's going to be pretty poor. So they're trying to be a leader, which has been incredibly good for valuations. Even though earnings have been tough, valuations will expand, and I actually think they will continue to expand, and we'll come back to the market in a minute. But in terms of how we were last year, we were seeing no growth domestically, and that's negative. And then the low interest rates globally had really inflated all assets. In America and also in Australia. And our concern was, with no earnings growth and within inflated asset prices, then where do we get the next kick? Now, where does the market, what drives the market from there?
Okay, well, that's a really good question. Let me throw some things at you, because when you were bearish, obviously the nature of the economy and the things that were coming to either help or hinder it weren't making you pleased. But the fact that average householders now have about an extra $35 to $40 in their skyrocket because of the petrol price.
100%.
Is that a good thing coming in?
And when did you last? What price did you fill up at?
Oh, well,
98 cents.
Yeah, that's right.
When was the last time we did 98 cents?
I know, it's staggering. The other day, I usually fill up. It usually costs me 70. It costs me about 45. That's
you're being modest. I thought your car would cost 100. No. Anyway,
I'm a climate supporter, mate. Anyway, I'm not as wealthy as you, I should say. Now, all right, so that's one thing. Low interest rates are here, and they're going to be low. Is that going to be another good thing to make you less bearish?
Okay. how I was looking at this 12 months, 2015, and we've said it. We announced the WAM result on Tuesday.
Yeah. I'll let you boast about that later. Right?
And in the outlook for the result, we said that we thought the first half was going to be tough this year to June, and that's because we didn't think the Reserve Bank would move as they did today. And so, but then we thought the second half is going to be good, and driven by exactly what you said. Lower oil prices, major stimulant for an economy, low currency, major stimulant for the economy, and also low interest rates. So effectively we'd have everything working in our favour in the second half. And now it's actually just happened quicker.
So it makes you a little bit more optimistic.
Exactly, that's right.
So also, the one thing I got from Tony Abbott's speech yesterday was he wasn't talking doom and kaboom. He was talking about economic growth and trying to create jobs. So this budget coming up, if it's a lot softer, is that going to be another plus for A, the economy, and B, the companies that you look at?
Could well be. Could well be. I mean, one of the interesting things is, well, in terms of my view on the Australian dollar, I think, well, in terms of against the American, we could be down in the 60s.
Would that bother you? Because you buy Aussie companies, don't you?
100%, yeah. It would only bother me if I wanted to travel to America.
Yeah, but we go to Europe instead, because Europe's going down.
Exactly, that's right. That's right.
Yeah. Or you can always go to Australia. There are some nice places here, Geoff, by the way.
No, definitely.
Yeah.
No, I totally agree.
Okay, so you're starting to see some good things. Now let's put you under the spotlight. You were very bearish last year. Are you less bearish now?
Well, let's put us in context.
In cash probably tells you.
Bearish, and we held a high level of cash.
What percentage?
We were 50% cash.
That's high for you,
about 50% cash, and it is. But the tough thing is, over 15 years, we've averaged 34% cash. And for the year to December last year, I mean, the WAM portfolio was up 11%, and the market was up 5%. So even though we had a lot of cash, we were still able to perform. And that was really...
Just unusual that you would boast about that.
No,
but it's a fact. It's a fact. That's why you're here.
They're all facts.
If you didn't do that, you wouldn't be here. I had someone else here.
That's right. But the interesting thing is, so it's really trying to find those companies that will grow, excluding the domestic economy. And companies we like. Slater and Gordon's one of our bigger companies.
Still like them, do you?
We still do. No? And we still think there could actually be more earnings upside. Incredibly well managed. One of the...
Are they going overseas, Slater and Gordon?
I mean, they've successfully grown...
Going overseas. So they're earning dollars and they're bringing them home as well.
UK. So there will be a benefit there. I mean, it was interesting you say about Stay in Australia. Another company that we bought since I saw you last is Amalgamated Holdings.
Why do you like them?
And they are doing very well. Another company we own is Mantra, and they're plugged into the
hotel game.
The hotel game.
It's Pat Rafter's company.
He's the face.
He's the face of Mantra. When he's away from his family, he stays at Mantra.
That's good.
You've missed that. In all your analysis. In all your analysis of that company, you missed that.
I missed the advertising.
Right.
But the interesting thing is, people are staying home, and with the lower Aussie dollar. They'll stay home more. And if you've tried to get a hotel room in Sydney, well, luckily we live in Sydney, so we don't have to. The market is tight. The market is tight.
But also, Geoff, if your view on the local economy improving because of those factors, business travel, the intrastate travel business. Companies like Mantra and Quest, they're beneficiaries of that kind of growth.
100%.
All right.
So I mean, there are a couple, and also on the Slater and Gordon side, IPH, they floated the latter part of last year. Again, it's a legal play and a roll up. A number of acquisitions. That's the old Spruce and. Business. So,
okay. All right. So there's some companies.
Well, we bought and we're happy. We'd be happy to buy more.
Okay. So what do you... I know you don't care about the index, but you obviously have a view. Do you, compared to 2014, which was a struggling year, do you think the index will do better this year because of what we're seeing now?
See, I mean, the interesting thing from a global perspective, there has been today, I think, quite a bit of offshore buying with the drop in rates. And as the Australian dollar falls, then even though the market's gone up, in US dollar terms,
they've lost.
Yeah, exactly. Or it's done very little.
Yeah.
So as the currency continues to fall, that will actually not only support the economy, but actually support the equity market too, in terms of foreigners looking at Australia and saying, hey, it's so much cheaper now. Yeah. Now's an opportunity to buy.
And obviously the big surge would come when there's a consensus view that that's going to be the bottom of the market, because you buy...
Exactly. Bottom of the currency, and the economy is clear signs the economy is picking up.
Yeah. So you buy a good local company at the bottom of the currency move, then you're getting currency gain. If you're a Yank, currency gain plus the profits and whatever.
Yeah, yeah. And you look at the US market, I mean, the PE the US market's on, it just does look... Even though everything's going well, it's been going well for a while and it looks expensive. The tough thing about the Australian market and the US market, from my perspective, is that we've had a pretty long bull market. And in terms of lengths of bull markets, this really rates up amongst the top in the last sort of 40 or 50 years. So we've had 5 to 6 years of quite a strong equity market. But in terms of short term, from an Australian perspective, a 25 basis point fall, if you believe that there's a direct correlation between interest rates, or an inverse correlation between interest rates and values of companies. Yep. So when interest rates fall, in theory, forget earnings benefit, but the value of companies go up. Yep. And
it partly explains why we've got up 9 days in a row.
Exactly. Expectation of that, and it was 70%, I think, of economists were forecasting that it would fall, that drop rates. But you actually, the hard thing is how much of it's priced in. Some numbers we just ran off quickly this afternoon, that a 25 basis point drop in rates rallies the market 5 to 7%. So now we've probably already had, we had 1.5 today, and we've already had a number of that in terms of the last week. Because if you look at how the international markets have performed, we've significantly outperformed them. So how much is left? Not quite sure. Short term, it looks so also technically. Today we broke. We broke out on the upside.
That sideways movement where we've got out of it.
And the technical guys are saying we could go to 6,000. So, my scenario was...
A bit late for me, but go on.
Yeah, that's right. Yeah. My scenario was more along the lines of, it'll be tough this 6 months. Yeah. And we'll have a really good second 6 months. Obviously, dropping rates a little earlier. Then, to me, the concern is if the market rallies too strongly... then everything will be...
Profit takers will knock the top of it, won't they?
Well, and also it'll all be factored in. So by the time we get the earnings, we'll have already had the rally, which we tend to...
Yeah, we often do. Now, I want to explain one thing, because 3 or 4 months ago in the Switzer Super Report, I wrote, this year I feel a lot of small companies that will benefit from lower dollar and the petrol price. That could be real improvers this year. But a lot of normal people can't pick those companies. No. I said, so you might play an ETF that goes after small cap companies, or you might go for something like WAM, your company. And a subscriber wrote to me and said, well, hang on, these guys are a 10% premium to NTA.
And I agree with him.
But you were $1.95 then, and you're $2.08 now on a 7% dividend. That was my argument. I said, if he goes up to $2.05, that's a damn good capital gain. So explain to viewers what that means as premium to NTA.
Listed investment companies have a diversified portfolio which is worth an amount per share. And so with WAM Capital, it's worth, our last stated one was $1.79 after tax per share. So in theory, that's what the value of our business is. Now, the share price finished today at $2.08. So why are they paying more? We try to buy things that are cheap. I try to buy things that are trading significantly below what the value of the assets are. And I find it hard to pay more than what something's worth.
Because you're a scab. But you make money out of it.
We've got a share purchase plan at the moment for shareholders that can pay $1.90. But still, it's a premium to the value of the assets, but a discount to the share price. And the fact that we've said we're going to pay 7 cents an interim dividend, and we've predicted that we'll pay 7 cents for the full year, so 14 cents. So it gives it nearly a 7% fully franked yield. So obviously people are going for that yield. Now, the premium discount really depends on what the market thinks of us. Like at the moment, they like us. Yeah. We could be in a situation where they don't like us and we trade at a big discount. One thing I remember years ago, we were trading a 20% premium and it's a 10% premium, and someone rang up and wanted to buy some shares, and I said, hey, don't buy them. They're expensive. Wait till we go to a discount. And he said, Geoff, tell me one thing. Do you think you're going to outperform the market by more than 1% per annum over the next 10 years? And I said, I'd be incredibly disappointed if we couldn't. So, I mean, it's hard, the premium discount. An interesting company that we've talked about before that we set up last year was Future Generation Investment Company. And that's
it's a LIC as well.
It's a listed investment company. The value of the assets are around $1.08. They're trading at $1.11, so only a little bit of a premium. And that's the one that has what I believe are Australia's 14 best fund managers that have said that they'll manage the money on a pro bono basis for free. And 1% of the assets go to charities and children's charities. So it's a cheap way of getting.
So this company doesn't do well. I can name all 14 of them and say they're a bunch of knuckleheads.
Oh, they're doing incredibly well. And to me, it's only because they've been incredibly generous that we've been able to do this. And Future Gen will announce our result in the next few days, but is on track of giving, I think, $1.6 million to children's charity. And it's only because of those 14 fund
fantastic.
managers.
It's a fantastic innovation.
But two things. One is you're buying something close to NTA, and you've got guys that are really good at their game. Paradise, Cooper, people like that.
Wilson's in there as well, isn't it?
Yeah, we've got a little bit.
All right, buddy. Great to see you.
Thanks, Pete.
Good luck.
Thank you.
Okay, so that was Geoff Wilson from WAM, Wilson Asset Management. After the break, to get a money market economist view on what some say was a shock rate cut from the Reserve Bank, Michael Witz of ING Direct is up next.